Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Jeff Weniger, head of equity strategy, WisdomTree, to discuss the ideal type of market to be engaged in, quality stocks as opposed to more speculative stocks. Jeff, it's great to have you with us. Welcome to Trade Talks.
My pleasure.
You got it. And when people talk about quality stocks, that can mean different things to different people. How do you define it?
Well, over at WisdomTree, I mean, it's really a function of screening for return on assets and return on equity. I mean, you can do the latter, but if you do so, you don't check leverage at the door. You have to combine the two of them. And if you do, it'll oftentimes help you with some downside protection, because what happens is if the bear comes along, like in 2022, and they start taking out some of the stuff 80, 90%, you end up with this basket of quality stocks, which is kind of critical over in the halls of WisdomTree. When you do that, you end up with a downside capture situation. So I think that's a lot of the appeal of these quality screens.
How much of an emphasis should investors put on quality screens?
From a total portfolio perspective, I mean, I guess you could do it across the board. I mean, you kind of talk about down the line to almost a retail client. Nobody ever complained to their financial advisor that they were buying them quality companies. I mean, it's one of those things where there is that lottery ticket effect in unsavory, junky style companies, where they work great during the boom times, but where you really earn your stripes is when it hits the proverbial fan, I guess you could say. So I'd say across the portfolio, you could do it in the US, you do it in Europe, Japan, EM. It's basically I'd say a factor for all seasons.
What is the ideal type of market to be engaged in quality stocks as opposed to more speculative stocks?
Well, I think if you get a reincarnation of something like last year, I remember the S&P had peaked on January 3rd of 22, and it was pretty ugly all year long. You got a ripping bull market here in 2023 on account of the AI speculation, but we'll have to see if that ends up persisting. I mean, if you anticipate that this quote unquote soft landing ends up not playing out, with something harder or an outright recession or just a multi-year slog, I would suspect that would be an environment that would be really accretive for alpha generation and quality mandates.
And finally, Jeff, how can the WisdomTree US Quality Dividend Growth Fund, ticker TGRW, fit into a portfolio?
Yeah, DGRW, and it's the portfolio ballast. It's the largest fund on the equity side of the business. There's $9 or $10 billion in it at this juncture. I would put it up against the Russell 1000. Put it up against the S&P 500. It's on its inception number, which is a little bit more than 10 years ago. It has outperformed, despite the fact that it requires a dividend and it never owned things like Tesla and Meta and so forth. It's outperformed a lower risk. So a lot of people are using it as the key core, if you will, in say a core satellite situation. So it's the ballast.
All right, Jeff, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.
My pleasure.